The data's been right. I like to say I don't have opinions, I have data. If the data goes the opposite direction, I'll be the first to start screaming bear market. But right now, the data is so strong. Clean data, clean scrub data, not the nonsense that gets reported. When you look at good, clean data, it's so obvious that things are continuing. And so we still expect good things for the S&P and for the U.S. stock market as a whole, really.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Today we have Joel Litman, Chief Investment Strategist at Altimetry, CEO of Valens Research, and an instructor in the Rural Classroom Plus. Joel is a globally recognized expert in forensic accounting and macroeconomic analysis, advising investors, institutions, and governments on what's really driving the markets. Joel, thank you for coming on the show.
In It to Win It. It was Steve Barton. I love it. Thank you for having me on the show, man. Really.
Well, thank you for being here. Thanks for being had. I'm looking forward to this discussion. I think our viewers are going to get a lot out of it. Sometimes we can be guilty of being in an echo chamber of commodities and natural resource stocks. And I first saw a presentation of yours at the Rural Symposium 2 years ago. And so far, I got to say, you've been spot on. You were basically, the room was silent because you were saying that, oh yeah, the S&P looks good, should keep on going up. And you've been right. So
well, the data's been right. I like to say I don't have opinions, I have data. If the data goes the opposite direction, I'll be the first to start screaming bear market. But right now, the data is so strong. Clean data, clean scrub data, not the nonsense that gets reported right every day by Wall Street, which is just garbage information. When you look at good, clean data, it's so obvious that things are continuing. And so we still expect good things for the S&P and for the U.S. stock market as a whole, really.
Okay, yeah, let's get right into it. You've got a PowerPoint set up with a bunch of slides emphasizing your points. Let's see what you got. I've got my pen and my notepad ready. I'm excited.
There we go. All right. So I thought it'd be worth talking about global economic profit. So what we did, and this took us, I don't know, 20 years plus, probably my whole career, really, since I started in public accounting in 1991, and slowly realized that the accounting numbers did not reflect economic reality. That was the issue. And then after several years in audit and accounting, I went into consulting, and then eventually, about 15, 16 years ago, left with a few people and said, let's go build out a true global database of apples to apples, uniform accounting numbers, cash earnings. And the results are what I'm going to show you, Steve, if that's cool.
Yes. Yes.
So this is this is visual capitalist. I love visual capitalist stuff, and they do things based on GDP, but is GDP really the measure of economic power of a country? GDP just measures total transactions, government spend, business investing, and consumer. It doesn't measure if those entities actually have growth, if they have innovation, if they have real economic power behind it. And so I contend that this picture is silly, and we need a redrawing of this, and I'm going to show you the numbers I'd base it on. And one of the numbers, anyway, is uniform economic profit. So this is economic profit in billions of the 3,500 biggest companies in the U.S. I mean, the S&P 500 already gets you like 90-something% of corporate America's, right, public listed corporate America. So at 3,500 companies, we're just digging deep, right? But basically, when you look at economic profit, you're like, of all those companies, around 300 billion. By 07, it was like 500 billion. So 07 wasn't really a bubble. It was just a high profit year, but companies were over levered, too much debt. We talked about this in the Rural Classroom, right, with Rick just the other day.
Yeah.
And that over indebtedness, over leverage. And so profits sank. By 2009, they sank to 300 billion at low level, which we didn't measure anything that low, except you have to go back to like 2001, like really the tech crisis and the credit crisis that occurred in 2000, 2001. And so it's 300 billion. And then that number pops right back up again, man, to $1 trillion by 2018. Of course, 2020 was a tough year, right? It was. But then look how it bounces again. Man, did the U.S. bounce out of the pandemic with not reckless abandon, but just amazing. And so by 2025, now we're measuring 1.6 trillion. We're guessing, we don't know, but it looks like, given the earnings growth we're seeing, that by 2026, we're looking at something like 1.9 trillion in economic profit with a T. Now, let me show you the rest of the world without the US. So this is 21,000 almost public listed companies. This is 6,000 companies in China, Germany, France, all the others added up 20,000 companies. And you see an economic profit that, all right, almost rivals the US in '07 and then goes negative in 2009, meaning the rest of the world really took it on the chin worse than the US did in '09. When that bounce back came, it didn't bounce back enough. And by 2020, it went negative again. The U.S. did not go negative. The U.S. still had true economic profit. U.S. corporates, small businesses, yes, there are bankruptcies, consumers got hurt, people lost jobs, but U.S. corporates were unbelievably resilient in a way that the rest of the world's corporates were not. And that bounced back, thank goodness for the world, but it bounced back in 22 and then really has sank in 2025. We're guessing the world's going to do better 1.2 trillion, but this 26 number I wouldn't put a lot of faith into. All right, I'm just saying we have some good guesses, but right now 25, that's a good number. We have a lot of quarterlies have come in. We have good, right, analyst numbers for that. So it looks like the world's at like 895. I compare the two. There's the US through 25, 1.6 trillion. Again, that's our best guess for this year, but corporate earnings does appear to be growing quarter by quarter at a clip that'll take us there. And then here's the rest of the world. All right. And of course, 2009, the US, believe it or not, did not suffer as bad as the whole rest of the world did. Same with 2020. The US did not suffer as bad as the whole rest of the world did. And then now the US is what, almost double the rest of the world combined? The rest of the world combined. So when we look at a stock chart of all the stock markets in the world, this is just from Statista. This is no fancy numbers, just Statista's total stock market cap. Of course, the US is bigger than the rest of the world combined because it generates more profit than the rest of the world combined by like 2 times. In fact, I could argue that the rest of the world still sees China in particular right now seems a little expensive. Their stock market relative to the corporate earnings, it seems a little expensive, right? Given that their corporate earnings is taking a tanking and the stock market is strangely up in China because of a lot of government manipulation and forcing banks and forcing people to buy Chinese stocks, meaning not allowing to buy anything else. And the renminbi is in such crazy flux that I think people are like, I'm going to buy gold or I'm going to buy stocks. Now, gold makes sense, to be perfectly honest. This is why the presentation I did, and we joked about this, I said, you don't have to have gold and the U.S. stock market going opposite directions. Gold can do well because the rest of the world's stock markets aren't doing well, because the rest of the world's currencies are in deep trouble. The ruble, the Brazilian real. So there's every reason to say that gold can do really well and the U.S. stock market can also do really well at the same time. And it's not some crazy, it's going to not work out. It's like there's good fundamental reasons for both. And so the presentation I did, if you remember, at the World Symposium in July in Florida was called Goldilocks for Golden Stocks. And that's it. That's what we're seeing, you know? And so, and by the way, if I take, because people always ask, there's the U.S., if you want to see China, here's economic profit of all of China. China's big, but the companies don't make a lot of money. Now, of course, Tencent in Hong Kong makes a lot of money. Alibaba does, but they don't offset all the negative profit from all these Chinese companies that are overly levered. And when you look at that, let me just close up. You want a reason to buy gold? There it is. If China is getting to that level of collapse, every Chinese person is going to want to be buying gold, right? Because I don't see how the Chinese stock market, which has been manipulated up right now, is going to hold when you have that kind of a collapse in economic profit and massive over leverage at the corporate level. China corporates look more levered and more poorly structured levered right now than the U.S. did in 2008 and 2009. Worse. And that's objective. That's just based on good, clean data. Now, China's accounting standards. So, of course, Steve, we have to adjust to get everyone using the same accounting, using the same uniform accounting globally. And when we do, we get to see apples to apples around the world. And that's a reason to be buying gold. The problems that the ruble's having and the rupee and everything are all reasons to buy gold. Yes, I think the U.S. dollar is not something I've invested, but I don't believe the big run up in gold is because of the dollar being in trouble. It's because the rest of the world's currencies and war is always hyperinflationary. That's why Poland is one of the biggest buyers of gold right now, the Central Bank of Poland, because they're worried about all these drones, everything flying in. And they know that if they go in a wartime economy, the Polish currency, right, is going to be in trouble. If NATO gets involved, the euro is going to be in trouble. So I'm not saying the dollar is great by any means, but it's the best of all the fiat currencies, of any major fiat currency. My goodness, the yen, which everyone always said the yen is the bellwether. And the yen's gone from 110 yen per dollar to 150 yen per dollar in what, 2 years?
Yeah.
2.5 years, collapsed. So that's another reason I'd rather have gold than yen. I'd rather have gold than RMB. I'd rather have gold than any of the BRICS currencies. That BRICS whole thing was a joke, right? So you have 5 countries that can't manage their own currency or their own economies. But if they get together, they're going to be able to manage a better currency? No way. No way. So, and even the crypto people, right? 99% of stable coins settle in US dollars. So when you add all that stuff together, right? No wonder the US stock market's as big as it is. Let me pause there, Steve, and let's, if you want to discuss any of this data that I'm sharing with all your viewers, and I hope they get something out of it.
Yeah. Okay. So GDP, you're saying, is basically not accurate because it's not a real measure of growth, right?
Well, think of it this way. So let's say you have a 25. All right, the U.S. is 25 trillion roughly last year, and China was like 19 trillion. So imagine you had a $25 billion company and a $19 billion company. But the $25 billion company makes a profit of like 20+%. And the $19 billion company makes no profit.
Okay.
Almost zero economic profit, right? That's the way to think of it. The problem with GDP is it just measures transactions and size. It basically, it's almost like the analogy is it measures revenue, but it doesn't measure the profit the revenue generates. It doesn't measure the spending power. It doesn't measure, because when a company has a lot of economic, it doesn't matter the real cash flow that's coming through, the cash earnings number that's available. This is another problem. So even if you look at the statement of cash flows, look at operating cash flows, it doesn't include debt service, and it doesn't include dividends. So even if a Chinese company makes money, you have to say, yeah, but how much of that money is going to go to principal payments, which is massive in China right now because they're so overly levered, these companies, and goes to any dividends they're willing to pay, right? And so U.S. companies, after they pay dividends and service all their debt, all the principal payments, you name it, still have $1.5 trillion of extra money to invest, acquire, spend, pay people more money, give bonuses, give raises, right? Chinese companies have no ability to do that because after they do make a lot of money, but so much that money is spoken for by debt and dividends, the cost of capital, there's literally no money left.
There's no money.
It's close to zero, right?
Okay.
And that's just the corporates,
Okay. Now, can you go back to UEP, Uniform Economic Profit of the U.S.?
Yep.
And okay, so the top one there, there's about 3,500 companies in the U.S. Is that right? And there's over 20,000 basically making up this chart for the rest of the world?
Yeah. Right? So we get the 3,500 biggest, corporates in the U.S. for the most part. Yeah, we don't have a handful of the super privates where we can't get good information, but we just left them out. So he said, all right. And then China, we have 6,000+ of their publicly traded companies, 5,500, something like that. Globally, what you're looking at is 21,000 companies.
21,000. Okay, so the U.S., the top 3,500 companies in the U.S. are making more profit than 21,000 of the rest of the world.
Yes, and now I switched to 2025 numbers because 26. All right, there's some forecasts in there, and who knows? Yeah. But for 2025, which we're in already, these are pretty good numbers. 1.6 versus 895. It's almost double the rest of the world combined. Wow. No wonder the U.S. stock market is bigger than the rest of the world combined because the stock market reflects the true earnings numbers, right? And you can't. The problem is if you try doing this with gap accounting and Chinese accounting standards and IFRS, which is implemented differently in almost every country that adopts IFRS. That's why they said all these countries adopted international financial reporting standards. But then why does Singapore call it Singapore financial reporting standards? Because they said, well, it's IFRS, but we changed it. And then China said, well, we use IFRS. And they said, well, why do you call it Chinese accounting standards? Well, because we changed it. Well, then how is it a standard if country is making their own changes for their own country? And the changes are major. They really make a total difference in the measuring stick of what is earnings, what are assets, what are debts. You put everyone in the same playing field and you get these numbers, and suddenly things just pop out. You're like, well, no wonder the U.S. stock market is not only in a bubble, but keeps going up because corporate earnings is so robust and it keeps going up. And no wonder so many of the other parts of the world, you're just like, is it a time to go to emerging markets? Is it time to go back into China? I don't think so. Not unless we can measure their earnings numbers going up the way it has in the U.S.
Okay. Okay. Yeah. If they're both, if the rest of the, if everyone else is looking at a different formula, then it's going to look like emerging markets are relatively cheap, and it's going to look like the U.S. Is expensive.
Yeah, yeah. It's even at one point we're looking at for the Singapore Stock Exchange, we started looking at the ASEAN indexes, the associated Southeast Asian nations, where you take out China and Japan, but you get Singapore and Indonesia, and Philippines, Malaysia, and all these up and comers. What we found was it was even more difficult. Every one of those countries has got their own accounting. Philippines has its own version of Philippine financial. So we had to fix all that first. And then we looked at ASEAN and we said, all right, there's a lot of growth there. It's promising, but it's small compared to the US's economic profit engine, and how much the economic profit engine has expanded since just 2020, right? From 700 something to, more than doubling, where the rest of the world, it's kind of like flattish. It looked like 22 things were improving, and then war is bad for economic profits. It is around the world. And when you have all these wars and all these things, and people are right focused on defense as opposed to focus on, innovation and entrepreneurship and whatever else, you get this situation. What's interesting, Steve, is we could have predicted this 20 years ago. And every time I say that, people are like, what do you mean you could predict this 20 years ago? I said, the reason you could predict 20 years ago is because when you break down the U.S. stock market, and you look at all the biggest companies in the U.S., 46% of all mega caps today were once publicly traded microcaps. Now you're like, well, of course they got small and got big. No. I'm talking about companies that replaced the mega caps. The mega caps used to be IBM, used to be GE, used to be whatever. Well, look at the top 7 companies now. How old are they? They're not 60, 70 years old. You go to Japan, the biggest companies in Japan were the biggest companies 20, 30, 40 years ago. The biggest companies in Europe, for the most part, were the biggest companies 20, 30, 40 years ago. Only in the U.S. do you have this leapfrogging of more innovative companies. And you want to get to the innovation. 50 to 60% of the entire U.S. market cap were once VC-backed startups. Nowhere in the rest of the world except maybe Israel. And Israel's, the whole country of Israel is the size of New Jersey. It's 11 million people. So it's what Israel's done is interesting, but it's a microcosm compared to the U.S. So when you look at 50, 60% of U.S. market cap were once VC-backed startups, you're like, well, no wonder we could have predicted this today. Because 20 years ago, this goes all the way back to 2006, 2/3 of the world's venture capital was spent in the U.S. And the rest of the world shared 1/3 of it. And now China's venture capital has been collapsing because they're running out of money. You could see it. VC funding has been collapsing. Other than government-driven, there's very, very little private funding of VC, private equity, foreign direct investment in China has been falling. So when you look at where the money for innovation today is, I drew the pie chart for you today. It'd be like something like almost 3/4 of all the world, meaning maybe 3 times U.S. venture capital is 3 times the rest of the world combined. Angel investing is probably 5 to 10 times more than the rest of the world combined. And that means that today's companies that are getting funded and starting up whatever, 20, 30 years from now, they'll be the biggest companies in the U.S., right? And yes, maybe Alphabet will be there and maybe, NVIDIA, whatever else. But we may see a change of the guard of lots of other companies because the U.S. has this and no other place in the world does. So you can easily forecast that, but wait a second. If this is where all the innovation is, well, that's where the economic profit's coming from 10 years from now, 20 years from now. Why wouldn't the U.S., right, be overly dominant 20 years from now from an economic profit standpoint, which also means more jobs, more employment, more money, more taxes paid. U.S. corporations pay a monster amount of taxes compared to the rest of the world. All right. U.S. corporate tax alone is like $600 billion a year plus paid to the U.S. government just from corporate tax. I mean, there's lots of countries in the world where the entire country's tax base. Russia's tax base is not even half what the U.S.'s only corporate tax base is. Russia's entire tax base of everything is still like half, less than half, 250 billion maybe. And that includes all the oil and gas sales, right? Versus the
Wow.
US. So, of course, this is going to continue.
Okay. Okay. Interesting. What so right here, what so if we got this for today, it's gotten even stronger. The
Yes,
US, it would take up
US,
three quarters, like you said. The blue part.
US has been increasing. Europe has held, but China has shrunk. Right, let me show you. I've got a chart on that. This is China venture capital since 2021, 22, 23, collapsing the
Yeah.
funding to the point it was barely 5 billion in that last quarter. And if you go to 2024, it's fallen even further. It's other than government driven VC, you just don't see venture capital in China like it used to be. So if we were to draw this chart again, the China slice has gotten a lot smaller. Israel's is probably about the same. India's probably about the same. Europe, I don't know, maybe smaller. If all the money they're spending on national defense and worried about Russia and everything else, and having to spend more for, as Trump keeps yelling at the European nations for not paying their fair share, right? Where does that money come from, right? When you spend more money on those kinds of things, there's less money available for innovation, which means, right, 20 years from now, you're going to have an even bigger differential between U.S. corporate economic profit and so we're saying, how can I make that prediction? Because we could have made the same prediction 20 years back, right? And so
Yeah.
I feel very comfortable with that for 20 years from now because of this is what's going on.
There's nothing good about war for your economy.
No, it's
Creating
hyper.
things and blowing them up is not a way to produce, more to have a good time.
Yeah, spending money to destroy things and killing your population off, especially your able-bodied worker population in Russia of the 18-year-olds to the 40-year-olds that got some of them got conscripted.
Yeah.
Well, those are all people that would have been working, would have been in IT. A lot of them were in IT, right? Or they escaped, and there's a mass exodus of millions of Russians into other parts of the world, Dubai, Istanbul, you name it, Israel. And you see, that with that, how does a country like Russia survive?
Yeah.
Russian Federation's done. There's a giant mistake for them economically, a giant mistake in terms of lives, but they're not going to recover from this and become the Russian Federation again.
Okay.
Even
Okay.
if they end the war tomorrow, right? There's too much brain drain. There's too much destruction. There's too much whatever.
Yeah. Interesting. Okay. All right. Sorry. Go ahead.
By the way, another reason to buy gold,
Yeah.
right? Another reason to buy gold. If I were Russian, I wouldn't want to invest in rubles, right? If I were in Turkey, I wouldn't want to invest in Turkish lira. If I'm in Japan and I see the yen go from 110 to 150, right, against a dollar, and I certainly wouldn't invest in dollars, but I will invest in dollar denominated securities before I'd want any other currency. And stable coins are dollar denominated stable coins of 99.8%. So the dollar's here to stay as a reserve currency for another 20, 30, 40, 50 years, right? The real issue, I know everyone's down the dollar, but I'm not saying invest in dollars. I'm just saying relative to the rest of the currencies in the world and the rest of the economies in the world, right? The U.S. is in really as they say, the catbird seat, whereas whereas all the other countries' mess is a reason where gold could continue to be in a bull market for quite some time. I'm in agreement with Rick Roll on that. But I also, when you see this, I'm also very, very bullish on U.S. stocks.
Okay.
Very.
The dollar is what's he call it? The cleanest shirt in the dirty laundry.
Yes. Yes. But who's saying invest in dollars? But I'd invest in dollar denominated stocks and dollar denominated bonds before I'd invest in any other currencies, bonds or stocks, given the mess that a lot of the world's in. And because of it, the lack of innovation, the lack of entrepreneurship, the lack of angel investing, venture capital investing, even corporate R&D in the U.S., because the U.S. has so much economic profit, they have more money for even corporate R&D. Swamps. I mean, it's grossly, right, dwarfs the rest of the world's corporate R&D. Because if they don't have the economic profit, well, that's where you get future R&D spend. It doesn't have it, where the U.S. does. So even plain old corporate R&D, forget about venture capital in the U.S., is so much bigger, so much more than the rest of the world.
You mentioned something. You had a slide on China not having much profit, and I read a lot about China not. How can I say it? Like their government likes to take over markets, and so what it does is it just dials up the subsidies on. Okay, we're gonna take over the nickel market, whatever it takes. Let's just go.
Yeah.
and they dump money in.
Yeah.
Could that be a reason for them not having as much profit as other places?
Well, the Chinese people are grossly overtaxed compared to U.S. So are Russians, by the way.
Okay.
I've said this on shows before, and they'll Google Russian income tax or Chinese income tax, and they'll come back and say that seems not that bad compared to the U.S. And I'm like, yes, but look at the social services, not taxes, but payments, like the housing payment, the unemployment payment, the health payments that are government paid. You pay to the government, and they're gigantic. I mean, you get way over 50-60% income tax when you include all those things in Russia or China. And so despite taxing the heck out of their people, like, in the United States right now, a married couple with 2 kids, I don't know if you know this, pays 0 federal income tax and then pays 7%, FICA and Medicare.
I did
Right?
not know that.
0. With married couple with 2 kids, you pay 0 federal income tax. In China, if you're only making $1,000 a month, $12,000 a year, the tax wedge is more than 50%.
Wow.
More than 50%. So when you have China and Russia, the same thing. Again, don't look at just Russian income tax. I always get this Google Russian income tax. You don't know what you're talking about. Like, no, you've got to add in all the other payments. And you talk to a Russian, they'll say like, well, income tax isn't that low, but there's all the other things. And when you add all the other things, that's the U.S. is a low 7.65%, 7.2 for FICA and 1.65 for Medicare or whatever. And then the employer in the U.S. will pay their share. If you pay it as a self-employed, 15%, you're also getting a tax deduction on that. Whereas in China and Russia, you add up all those things, you go way above 50-60%, the tax wedge that they have. And so when you look at that subsidies that you mentioned, if they take all those taxes, of course they can rob Peter to pay Paul. And they say, we're going to dominate solar, subsidize solar like crazy, sending, European and U.S. companies could not compete with solar photovoltaic that, China, crushed the world in photovoltaic because they were so overly subsidized. Then when all these companies in the U.S. and Europe, not all of them, but most of them, right, really go under, went bankrupt, done, because they can't compete with that kind of predatory pricing, then Chinese photovoltaic starts going up and they own 80% of the, solar power equipment market or whatever. They began doing it with EVs because they said, hey, let's just subsidize EVs like crazy. So you could buy the fantastic BYD car for like 10, 11 grand because they were getting subsidies of 12, 13, 14 plus $1,000 per car. When you include also the cost of electricity that China has because they're using coal-fired plants. And China did the 2-step. They said, we're going to sign the climate accords. We've got to stop smog. We've got to stop everything, which of course, everyone stopped using coal. Germany shut down coal plants. The U.S. stopped building. Across the world, you had, and then China and India turn around and start building coal plants like crazy because the price of coal collapsed. So China went and built 3,000, 4,000 more coal-fired electricity plants. So you can make electricity so much cheaper when you don't care about destroying the environment, destroying the world's air, which is exactly what China did, right? It was a 2-step. And so they get cheap electricity, which you could call in a way subsidized because, you want to put aluminum in a car. Aluminum is a massive electricity user. Well, China can produce aluminum without that kind of, right, electricity issue that Germany now has in other parts of the world because they shut down all their, not all, but many of their coal-fired plants or whatever. So when you look at those subsidies, yes, China could do that. And they could have done it with EVs. The U.S., buy a Tesla and get $7,500 doesn't compare to China putting in all kinds of subsidies and the electricity 2-step, as I call it, and whatever that allows them to produce a car for so much cheaper and sell it for so much cheaper. I think Europe and the U.S. caught on early enough and said, all right, we're slapping 100% tariff on here just to get it back to something close to market. I still think it doesn't. When you include the cost of electricity and this coal 2-step that China has played on the world, Chinese Communist Party, I don't want to make it sound like I'm against Chinese people, but the Chinese Communist Party is responsible for all this, nonsense. When you look at that, you're like, thank goodness they put 100% tariffs on those cars because otherwise they would have destroyed the world's EV car makers just like they did with solar. Thankfully, the world got smart to it pretty quickly, and you'll still have EV cars made around the world. But they might have crushed the EV car making business the way photovoltaic if the countries didn't get smart and catch on to what they were doing.
Yeah. Okay. Okay. I'm sorry. Was that the end of the slideshow?
Yeah. Just and then if you go back to if you were to rebuild this slide, it would be half of the world plus would be the United States. If you use the measure better than GDP, like economic profit and other things, even with consumer, right? You really should be looking at discretionary spending, not total spending by the consumer. I mean, if someone in China makes 12 grand, they get taxed 6 grand, they've got $6,000 to spend, and all of it goes to housing, telecom, and food. That doesn't mean you have economic power. It just means you have a lot of people, right? But that doesn't mean they have economic power. U.S. discretionary spending is more than the next 20 countries combined. U.S. consumers have more discretionary spending. That means after tax and after cost of living than the next 20 countries combined.
Yeah,
right.
Able to go to the movies and buy stuff
Go out
that
to
you really
eat.
don't need.
Yeah. Right. Go out to eat, buy an extra car, get an apartment, do whatever. I mean, it's funny because if you actually look at iPhone sales around the world, it literally follows a graph that looks almost exact to consumer discretionary spending by country. It's like a lockstep because who can afford a $1,100 iPhone other than someone who has a lot of discretionary spending? And iPhone sales almost look like an exact graph of consumer discretionary spending ability country by country by country. All the way down to if you go all the way down the bottom 20 countries, it still holds like that. And which actually gives us faith that our consumer discretionary spending numbers, which have to be done after all taxes, not just income tax, but after all taxes and after cost of living is taken care of. And so if you drew that and you drew that with economic profit, and you drew that for the world, you'd have the U.S. would be more than 50% of the world and the rest of the world sharing 40 something plus percent. And where it's headed is 20 years from now, where the U.S. will be 3/4 of the world truly with economic power, economic profit, consumer, if you call consumer discretionary spending is sort of like consumer economic profit, the money you really have to spend after everything else. All right, you would have the U.S. easily 3/4 of the world 20 years from now, and the rest of the world sharing 1/4 of the world's economies. That also means, by the way, the U.S. can continue to spend more in military spending than all the rest of the world combined and continue to afford to because of all that. Yeah. By the way, it's another reason why the U.S. doesn't have as bad a debt problem as people think. I'm not saying Congress isn't irresponsible, but Congress's irresponsibility keeps getting bailed out year after year by the massive profits and the massive consumer wages that when taxed at lower levels than Russia and China, bring in more tax revenue than any other country in the world. And that tax revenue is used to support, the debt service.
Maybe, do you have a slide on the Laffer curve?
Oh, I don't think I have it in this presentation, but
okay.
It's easy to draw mentally.
Go ahead, do me a favor and stop sharing your screen.
Sure, of course.
Basically, the Laffer curve. You did a presentation on this in the World Classroom, and if you can visualize a curve that kind of looks like the first part of a Lassonde curve. Actually, it's like goes up like this and then comes back down. And there's kind of a sweet spot for governments in the middle. If you don't tax enough, then you're not getting as much income as a government. But if you tax too much, it kind of incentivizes people to not work as much because they're like, well, the more I work, now they're taking more in tax. You know what I mean? Maybe can you go into that?
Yeah. So China and Russia are way past the peak of the Laffer curve because anytime. So one of the worst periods of U.S. economy, and this is one thing we talked about, is that right the 1970s had high inflation, but the 1930s had deflation. So to always say the worst economy is because of inflation, right, or deflation is tougher than noticing a perfect correlation with income taxes. So what did you have in the 1930s? You had FDR, eat the rich. He didn't say tax the rich. His slogan was eat the rich. And he let personal income taxes go above 70%. Well, what happens when income tax goes above 70%? Entrepreneurs stop being entrepreneurs. People stop working. And black market goods skyrocket. Right. Well, right now, China is way past 60, 70% when you include the total tax wedge. You can't just say income tax. You got to include all the housing taxes and welfare taxes, unemployment taxes that come out of your paycheck. They're way past 60, 70%. Well, which country in the world has the biggest black market in the world not just per capita, but in total, China does. Why? So that and the problem with black markets is they may keep the economy going, but the government can't tax it. The whole reason the black market exists is because the government's grossly overtaxing, right? Well, in the U.S., yeah, I'm not saying that people don't sometimes evade their taxes, but right now, most U.S. people are like, all right, tax me 30%. All right, I'll pay it. Tax me a little more, I'll pay it. But you start going above 50%, California, right? When you add in federal plus California's 13.5, plus their excise taxes, plus their sales taxes, why do you think people are leaving California? And as people leave California to go to Texas and Florida or other lower tax states or no income tax states, what you end up getting is that Laffer curve situation where the tax rates keep going up, but the population and the black market and the lack of entrepreneurialism starts shrinking, starts getting pulled back. Now, I don't think there's going to be a lack of entrepreneurialism in Silicon Valley, right? But you have heard people talk about splitting Northern California from Southern California. You've heard it. It comes up. It comes up, and and part of the reason is the drag of Governor Newsom and a lot of other just wacky policies that they don't realize that people have human behavior, and if you overtax, so Laffer curve, if you do 0% tax, of course you collect zero tax revenue. If you go to like 17, 18, 19, 20%, there's sort of sweet spot there. That's what Hong Kong's tax rate was pre-China mainland taking it over. And that's Singapore's tax rate is somewhere in that 17 to 20%. People are perfectly happy with that, right? And look at how Singapore, with barely 6 million people, half of them, right, or more are foreigners or expats or whatever else, maybe not half, a third of them. But either way, 6 million people. And it has one of the biggest GDPs per capita in the world and just one of the big absolute GDPs, right? Several $100 billion for a small country of a few million people, really. And part of the reason is really good tax policy. You go to China, more millionaires are leaving China every day, right, than any other country in the world. How many millionaires left Russia with the last couple of years? And now what is Russia doing? Because Russia's realizing they're running out of money for the war. They just announced this in the last few weeks. They're raising taxes.
Are they really?
Well, Russia just announced they're raising taxes again. Not to mention outright conscription taking of assets of companies and stuff that they've already done of a lot of foreign companies. Just say, we're just going to take your assets anyway. That's 100% tax. But they are increasing taxes on Russian people and Russian companies. And when they do that and increase those taxes, it's going to make people want to leave more because they can. If they can, they'll leave. Or why bother being an entrepreneur? If I'm going to make $1 million and see 75% of it go to the government, why don't I just work? It's easier. It's easier and more certain.
Or leave the country and go somewhere where you can keep more of it.
Such as the United States, where you can get the venture capital and the ecosystem and angel investing, everything else. And so the United States still gets the world's entrepreneurs because of all that, which is why we can make these forecasts for 20 years from now, bringing this full circle, Steve.
Yeah. Okay. What are some warning signs that you would see if we started to? I'm going to bring up the S&P 500 here. So
sure.
Like what? Here's the last. I don't know. Since October 2022, we've just had a nice climb. We had a little dip over here on Liberation Day when Trump held up his chalkboard and decided to start tariffing random islands and stuff, and it just continued to climb up. What would cause you to think that this is going to start to roll over? What data would you see that would make you believe that?
Well, the current S&P 500 level requires pretty much a continual 7% earnings growth rate. That's uniform earnings of corporate America, when what we're measuring is closer to 9%.
Okay.
Meaning all the innovation, all the R&D, and frankly, the Trump's tax cuts from 2018. People are like, oh, these tax cuts are just going to lead to more share buybacks and dividends. Yes, there was some of that, but corporate R&D post the Trump tax cuts in 2018 skyrocketed by like 30% over the next 4 years, just 3-4 years. GDP didn't grow by 30% in 3-4 years. In fact, 2020 was a pandemic where everything shrank. But U.S. corporates, because of that tax break, they didn't only increase dividends and share buybacks. They also increased R&D spend and innovation. They also increased CapEx at levels, meaning started reinvesting at levels that went beyond anything that GDP. Again, GDP is such a bad number. it's not a bad. It's not that I'm saying GDP is badly calculated. I just don't think what people use it for is what the calculation tells you. But when you look at all these other things like economic profit over, no wonder when the companies took those, frankly, the tax cuts, that was, if the Laffer curve ever showed up for real, the amount that taxes that companies pay, the U.S. is paying 39.5% corporate tax. And then when the U.S. companies pay a dividend, we as individuals pay another 20 something percent tax on top of it. So you really were above 50%. Trump dropped that to 20 something percent. And when he dropped it 20%, of course, we didn't see more taxes the next year. The New York Times was called the Laffer curve of laugh. They made fun of the guy's name. The New York Times is such a crappy. Anyway, sorry. So anyway, so New York Times is making fun of Laffer's name. What a laugh! The Laffer curve doesn't work. And I'm like, well, of course it's not going to occur in 1 or 2 years. But companies were paying $200 billion in corporate taxes to the U.S. federal government in 2018. The next year was about the same. The next year was about the same. Now, today, they're paying $600 billion and probably 550 to 600. We'll see what it comes out to be by the end of the year, but something like 550 to 600 billion dollars in corporate taxes to the federal government. So corporate taxes tripled on a lower tax rate because one, the lower tax rate caused a lot of U.S. companies to stop leaving money overseas. They repatriated a lot of it because they said, "Oh, it's a lower tax rate. I'll repatriate it." And then the other side is that they reinvested and corporate earnings skyrocketed to such a point that there's so much more taxes paid on such higher profits. So when you put all that together, that's going to continue for another 4, 5, 6, 7, 10 years. At least it seems to be. The data suggests it will be, and why we could predict 20 years out.
Yeah.
Philosophically, what could end it, Steve? Because we talked about this. Philosophically, yeah, a repeal of the First Amendment. If you actually get rid of the First Amendment, because free speech, right? So let me say it a different way. Entrepreneurship is naturally disestablishment, right? To be an entrepreneur means I don't like the way you're building cars. I'm going to build a car better. I don't like the way your banking is. I'm going to build a better bank. I don't like the way you're manufacturing. I'm going to build a better manufacturing thing, right? That's entrepreneurship. Well, if you don't have free speech, because every time you say in China, like Jack Ma, I don't like any of these banks, and they're state-owned banks, and they call up Xi Jinping, and suddenly they say, Jack Ma, stay in your hotel for the next 3 months. Don't appear on your own television show. We're going to shut down your university. They had all these students. I don't know if people know Jack Ma had his own university. It was like a...
I didn't know that, no.
Yeah, it was like a Babson, or it was like this entrepreneurs university. And they had people that had been there their senior year in high school, and they just canceled it. Grades not useful, no transcript, and they canceled the school's license because they said Jack Ma was talking too much nonsense. They shut down an entrepreneurial school. They shut down one of the greatest entrepreneurs in history, in my opinion, Jack Ma, right? And why? Because he was saying, I'm going to fix the banks. And the banks said, no. And they took his bank, A-N-T, and chopped it up and fire sale prices to the biggest banks in China, right? Well, this is what entrepreneurs are going to be in China when people see what happened with Jack Ma, right?
Yeah, yeah. Good point. Good point. Okay, you told a story in the rural classroom the other day about your you called it "Rich Mom, Poor Dad." Could you elaborate on that?
You know, my father, this is very personal, but my father, you know, was a doctor, and he was a doctor pre-HMOs. This is like the 1970s, 80s, and he made a lot of money. He made a lot. In today's dollars, it is like $500,000 a year. I mean, it was a lot of money in 1970s, even inflated 1970s dollars. And he was a pathologist. It's a tough job, pathology. He worked hard. I remember he worked 70 plus hours a week. But when he wasn't working, he was taking phone calls. And, you know, I call it the sheep of Wall Street. Him and others like him, meaning when you see those movies like Wolf of Wall Street, right? And the scumbags, right, at the Wall Street firms that were calling people and getting them to buy these penny stocks and biotechs and whatever else. My father was one of those millions of people, especially doctors. They love doctors on the other side of the line. And he would always be chasing that get rich quick. And he'd be investing 50 grand at a pop and 20 grand a pop. And I mean, crazy amounts of money. And over the course of 20 years, right, when I was around 18, 19 years old, my mother and my father got a divorce. And lo and behold, he didn't have much money. I mean, the house was there, but the house still had a mortgage on it. And it was like, why? If he's making that kind of money, because he literally lost millions of dollars in the stock market chasing these crazy Jordan Belfort types, right? And I remember it was Payne Weber and Dean Witter and all of them. And they'd call up and I'd answer the phone, and I was like 9 years old, 10 years old, 11 years old. They're like, hey, is your dad there? I really got to talk to him. I'm his, advisor, whatever. That's it. So when people say I have such a anti-Wall Street bent, you can see where it comes from, right? I don't trust Wall Street recommendations. They're just as bad today. They're more regulated today, but I still wouldn't trust a Wall Street recommendation ever, right? Their buy-sell opinions are a joke. They're garbage. Actually, the sells might be worthwhile, but the buy and hold opinions are nonsense, right? Anyway, that's proven. There's so much data behind that. By the way, if you ever want to see the data behind that, of how bad Wall Street recommendations are across all of the biggest 50, 60 investment banks. Horrible. Anyway, where's my mom? So here's my mom, and it's 1990 something, early 1990s, and she doesn't get much. She gets the house and a little bit of money, and she has to work, so she starts working, and she says, "What should I do with my money?" Right? And who am I? Right? I was just starting in public accounting in '91, and I said, "Well, I've been following some of these alternative newsletters like the one I've built at Altimetry, right? And one was this guy named Bob Brinker, and Bob Brinker's passed away now. But Bob Brinker, and he says, just put money in U.S. equities every month and just stick with it for the long term and through thick or thin. So I told my mother to do the same thing. So, she put about $1,000 away a month, right, from her job. She was a CPA, but my mom never made $100,000 in a year, right? If anything, I don't think she's ever made even $80,000 in a year. I don't think she'd mind that. But she put every month $1,000 away. And I remember she was doing that from 91. Think about that. Through 2000. I remember in April 2000, I said, "Ma, the market's getting a little toppy." She's like, "Nope, I'm still in." And so the market drops. But to her credit, she kept putting in $1,000 in 2001. 9/11 hits. She's buying more. And she's been doing this for 30 years now, 34 years. So you could do the math. You don't have to I don't have to give you any specific numbers, but she's got some nice accounts sitting around, and she doesn't wear fancy wallets carry Louis Vuitton purses or fancy watches, but she's done very, very, very well because, that's slow and steady wins the race. And so whenever I talk to people like, should I start buying this stock or that stock? The first thing I'm like, first off, are you putting your money in VOO every month? Right? Because $1,000 in VOO in 20 years is going to be about $1 million.
VOO is the S&P 500.
Yeah, VOO is Vanguard, the letter V. I like VO because it's easier for people to remember. V like the number 5. OO like 500. If you're going to say 500 in letters, you'd say VOO.
Yeah,
right?
yeah.
And it's Vanguard, and they only charge 3 or 4 basis points, and it's super liquid and super, well built on the S&P 500. You buy $1,000 of that a year for the next 20 years. It's going to be $1 million
a month for 20 years.
$1,000 a month every month for 20 years. So a 22-year-old, I tell all my students this. In fact, I just had an undergrad class earlier, a corporate finance class, and I said, once you start working, put $1,000 away. And by the way, if your company matches, you only have to put $500 away. And the $500 away, if it's in a 401k, you'll only cost you $350 because it's tax deductible. You'll get more taxes back at the end of the year. So for $350 a month, if your company matches, right, in 20 years, that'll be $1 million, right, in the S&P 500. I give or take $100,000. Don't sue me if it's 990 or 950 or something, right? But I think there's a good chance, given everything this thing with venture capital, everything else, that you're going to find another new set of Mag 7 companies, right, that are up there. By the way, Steve, this whole thing it's all about the Mag 7 and its toppy. And I'm like, no, hold on a second. Steve, how many stocks do you think have doubled this year? Have doubled. In fact, the last 6 months, doubled in price. Is it only the Mag 7?
In the S&P 500, you mean? Or
no, in the U.S. stock market, 5,000 companies or so. How many stocks have doubled? More than 100%, some 200%, but
you told me this the other day. It was like 400 or something, wasn't it?
408 companies. 400. Why is the media not reporting this? The breadth. It's not just the Mag 7. And we're like, oh, it's only the Mag 7. There's nothing else to buy. I'm like, what are you talking about? Hyatt is up 129% since I recommended it to our clients. Build-A-Bear, we recommend our clients, is up 85%. Build-A-Bear, right? They're like, is it all tech? No, there's all kinds of companies. Yes, tech, but also like cable companies and infrastructure companies. And we've got one of, I think, our best stock picks is like a PVC piping company, because you can't build data centers without a lot of piping for all that cabling that's needed. And the company is a little company that's having a fantastic run. So, the breadth of the U.S. market right now is fantastic. And that's why we're like, just buy the S&P 500. So yes, you get the Mag 7, but yes, and that may be 30-40%, but you also get the other 60%, right, of everything else that's pretty juicy.
Right? Okay. Awesome. Joel, thank you very much. I love your work in the rural classroom. It's always fun when you come in,
Thank you, Steve.
because you give an alternative perspective, and you make sure that we're not sitting in an echo chamber with each other. So that is fantastic. But
but lately I'm echoing it too. I'm all about
yeah,
it also for all the reasons we gave. It's not, it's just that where I differ is saying that just because gold's up doesn't mean the stock market's down or the U.S. dollar is dead.
Yeah.
Right? There's every reason to think gold would be up, and the stock market, and then it could be up, and even dollar denominated be pretty good. So anyway,
yeah. Awesome.
Hope that was good for your viewers.
Oh yeah, Steve? they're gonna eat this up. Thank you. If they want to get a hold of you and follow your work, how can they do so?
Altimetry.com.
Okay.
Altimetry.com.
We'll in the show notes below.
Very easy.
And we'll put links down to the rural classroom as well. We'd love to see you in there. Joel, thank you for coming on the show.
Thank you, Steve. Pleasure.
Yes, sir. And thank you for tuning in. Go to stevebartonmoney.com for more, and have a wonderful day.